What's up again? This is Sunko, the Korean bro. I turned YouTube Live off because it was so slow because of some kind of programs running on the background of my computer, and it made my speed of my whole computer slow. So I just made it stop, and then I'm back here. Let's get back to where I was. I was talking about CPA indicator, right? CPA, let's repeat this again. CPI indicator measures a change in prices which consumer must pay for a fixed basket of consumption goods and services in urban areas. All goods and services intended for consumption, including applicable taxes and fees on the product at the time of sales, are included in the survey. Consumer price index, that's what it is. And we have core retail sales. It's also announced today in America. Core retail sales measures the change in the total value of sales at the retail level in the US, excluding automobiles. Change the total value of sales. It is an important indicator of consumer spending and is also considered as a pace indicator for the US economy. A higher than expected reading should be taken as positive bullish for USD, while a lower than expected reading should be taken as negative bearish for USD. Okay. And let's go to market beat. What's up with today? Global stocks up after Wall Street bounced from inflation jolts. Okay. The short selling AMC mean the stock is a horror movie. Is Taiwan Semiconductor a good investment for 2023? Trinzo gets a downgrade, but that doesn't stop it from advancing. Delta Airlines looks ready to take off. Okay. Retail sales flat in September as inflation takes a bite. Stocks open higher on Wall Street as banks healthcare led. Utility begins loading fuel at new Georgia nuclear plant. Okay. Nothing new here. Okay, let's get to the article here. Global stock market surged Friday after Wall Street rebounded from a slump caused by higher than forecast inflation numbers. Market benchmarks in London and Paris opened up more than 1%. Tokyo jumped 3.3% for its biggest one-day gain in 7 months. Hong Kong and Shanghai also rose. Benchmark US crude rose almost $2 per barrel. On Wall Street, the future for the benchmark S&P 500 index was down 0.4%. Wall Street slumped Thursday after U.S. consumer price index for September rose 8.2%. But the S&P rebounded to end up 2.6% for its biggest daily gain in 2.5 years. The sticker shock of inflation was shrugged off, possibly because traders already expect another sharp interest rate hike from the Federal Reserve next month to cool surging prices, said. So here it says, we already know that Federal Reserve would have another interest rate hike next month. So CPI number doesn't really make them scared. So the Fed and central banks in Europe and Asia have raised rates by unusually wide margins this year to contain inflation that is at multi-decade highs. Traders worry they might tip the global economy into recession. In early trading, the FTSE 100 in London rose 0.6% to CAC 40 in price gained 0.8% to DAX in Frankfurt advanced to 0.5% to okay. The short selling in AMC mean the stock is a horror movie. AMC's short interest ratio is currently 2.4, meaning that's how many days it would take for the total number of shares sold short to be covered and then closed. The most recent percentage of AMC shares shorted is 19.14%, which is down 1.1% from the previous report in mid-September. Its losses are narrowing, and the company has even beaten views in recent quarters. Is Taiwan Conductor's good investment for 2023? Taiwan Semiconductor is the world's largest chip maker foundry and is fundamental to the entire complex. The stock trades at a deep discount to the broad market and pays a 2.8% dividend yield. Near-term headwinds may impact results over the next quarter or more, but long-term trends point to a rebound in 2023. As the world's first and largest pure play on semiconductor foundry manufacturing, Taiwan Semiconductor may be the single best individual investment in the semiconductor space. The company does not make or market its own products. It manufactures semiconductors for suppliers ranging from Apple to Nvidia. Does not make or market its products. It manufactures semiconductors for suppliers. So they're like the main semiconductor supplier. Okay. And just about every fabless semiconductor company on the market. In this light, the company is exposed to the semiconductor industry and not one sector, segment, or industry. And so also gives ample diversification. And add in the low 10 times earnings multiple and the dividend, which is yielding close to 2.8%, and the stock looks very viable. So they're not only solely focused on one product, and they don't even put an effort into do some marketing or making its own product. They're mainly supplying semiconductors to semiconductor chips to Apple, Nvidia, and with a diversification, they're less as a long-term investor. It's less risky investment. Adding the low 10 times earnings multiple in the dividend, which is yielding close to 2.8%, the stock looks very viable. The caveat is that there are some factors in play that may make waiting to buy a better option. Okay. So author recommends that you should buy it a bit later. Okay. Trinzo gets a downgrade, but that doesn't stop it from advancing. Morgan Stanley lowered the price targets on chemical and plastics maker Trinzo. Chemical and plastic maker Trinzo. Trinzo has a market cap of just $670 million. It is still in its relative infancy as a public company, having IPOs in 2014 after being formed via spin-offs of 4 business units from Dow. Trinzo is tracked in the S&P 600 Small Cap Index. A small Pennsylvania-based maker of synthetic rubber, latex, and plastic products sold to manufacturers. But analysts at Morgan Stanley sure are familiar with Trinzo, lowering the price target from $33 to $20 with a designation of equal weight. That new price target is only fractionally higher than where it's currently trading. So a lot of analysts must have put good rating on this one. But since I'm not really interested in chemical and plastic maker, I'm just gonna skip. Delta Airlines is one the best performing of the airline majors in recent weeks. Shares are continuing to consolidate after multi-month sell-off. There's a strong case for a recovery rally to start picking up pace. Okay. Mm, Delta Airlines. Okay. A 4% jump in Delta shares on a day when the S&P 500 index sank to fresh lows is a good indication of what they might do over the next few months. The catalyst for the move higher was the company's quarter three earnings report, which was released just before the bell rang to start Thursday's session. Revenue was up a solid 53% on the year and ahead of the consensus, while bottom line earnings were marginally short of the $1.53 analysts were expecting. All in all, positive headline numbers. But the deeper you went into the report, the better it got. Delta is now forecasting EPS for quarter fourth to be between $1 to $1.25, well ahead of the consensus for $0.80. Given the tough 18 months their shares have logged, there's a growing argument that we could be on the verge of a major recovery rally. Since their post pandemic move higher ran out of steam back in March of last year, shares have trended lower some 45%, though still well above the low of May 2020. Hmm. This consistent lack of demand for shares is at odds with the overall bounce back in air traffic numbers. There's only one real culprit to point the finger at here: inflation. So although we have a recession recently, and it's still recession is an ongoing process, and quarter four report here. Here it says, although S&P 500 index sank to fresh lows, it went higher, which is a good sign. Uh, and During pandemic, COVID-19 pandemic, uh, of course, people will not go abroad, and people will hesitate to go abroad. Um, but then as it gets to the end, um, people will have a tendency to use it more often. So demand will go up, right? Hmm. So its outlook is really good, is the point of this article. Hmm. Let's go over to Motley Fool. Okay. How much in Medicare premiums will be deducted? Here's your Social Security raise. Three once in a decade buying opportunity. The Dow Jones bear market. One stock split, stock to buy hand over fist, and one to avoid like the plague. Two monster stocks you will want to buy now and hold forever. One scorching hot dividend stock, down 58% to 75%. These three growth stocks are poised for a comeback. The smartest stocks to buy with $20 right now. Social Security 8.7% call it. When will you receive your checks? Okay, let's see. Here's why this fintech is a no-brainer growth stock. Just so you know, I'm getting sources from the website called the Motley Fool, and this is written by Courtney Carson. Let's see who that is. Certified public accountant based in Florida. Courtney covers anything financial, including insurance, banks, REITs, fintechs. In his free time, enjoys golfing or reading. Okay, that's TradeWeb Markets appears to be one such opportunity. TradeWeb, the fintech, runs a trading platform for big investors and consistently takes market share from its competitors. Bear markets present opportunities to buy companies at prices that would have seemed unheard of a year ago. Bear markets present opportunities to buy companies at prices that would have seemed unheard of a year ago. Okay. Hmm. The bear market enables you to buy this top touch company at the lowest valuation in years. Okay, let's see. Bear markets can be a painful experience for investors. After all, no one likes seeing their portfolios lose value. However, long-term investors know better. Bear markets offer opportunities to buy excellent companies at discounted prices. The chances of buying in at the bottom of a bear market are tiny, so you gradually want to build positions over time in stocks you know have what it takes to recover an axle. You can do this by focusing on quality companies with impressive growth and that also delight their customers with their service. One company grabbing market share and achieving impressive growth is Trade Web Markets. Okay, let's see. Trade Web Markets. Okay, let's see. When the big players on Wall Street trade things like U.S. Treasuries or corporate debt, they turn to a trading platform like Trade Web Markets. TradeWeb helps hedge funds, central banks, market makers, and other institutions make trades on its digital platform, which was introduced in 1996. The company's first tradable product was U.S. Treasuries, a market that used to rely on telephone orders to conduct trades. Since then, it has expanded to offer digital platforms for European bonds, corporate debt, equities, money markets, and derivatives related to those assets. Its growth is hard to ignore. Since 2004, TradeWeb's average daily volume or total volume of the products traded on its platform has grown by 14% annually, and revenue has increased by 13% annually. Okay. Delight its customers with this simple secret. Okay, what's simple secret here? Secret. What makes TradeWeb stand out is its commitment to providing its clients with the best trading experience possible. For example, it acquired Nasdaq's fixed income trading platform for $190 million last year. The acquisition improves clients' access to trading treasuries while also reducing the cost of trading, which can add up when you do billions of dollars in volume daily. Another way TradeWeb stands out for its clients is by protecting their trading information from other market participants. Protecting their trading information from other market participants. Information leakage can allow sophisticated traders to front run their clients' trades, making it more expensive to complete big block trades. By protecting their trading data, TradeWeb saves clients money and gains their trust and business as a result. Hmm. TradeWeb competes with Nasdaq, Market Access Holdings, Intercontinental Exchange, and Bloomberg. The company must keep customers satisfied returning for more with such intense competition, which is precisely what they're doing, taking market share. Expensive addressable markets, okay? Snatching market share away from the competition. In 2016, it had a 7.5% slice of the US Treasury market. This year, its market share is 19.6%, nearly a threefold increase. Treasuries aren't the only area where the company is expanding. Since 2015, TradeWeb's average daily volume has increased multiple times that of the total market across the different assets, which you can see below. Its business also enjoyed tailwinds from increased trading activity this year. According to Fitch Ratings, global interest rates rose at the fastest pace in over 30 years. As central banks try to bring down inflation, rapidly rising interest rates result in more volatility in products like U.S. Treasuries and corporate bonds. TradeWeb rips the rewards as volume on its platform proliferates. Hmm. The stock still trade at a premium but became much cheaper in 2022. Okay. Three once in a decade buying opportunity in the Dow Jones bear market. It's been an abysmal year for investors, with the timeless Dow Jones Industrial Average plunging into a bear market. The silver lining is that bear markets are a surefire opportunity for patient investors to go shopping. These three stocks are historically inexpensive and ripe for the picking. And what are they? Walt Disney, Visa, Intel. Mm, Let's look at Intel here. Hmm. Wow. The third once in a decade buying opportunity at Dow Jones bear market is semiconductor stalwart Intel. It's been nearly a decade since shares of the Intel were this far below their all-time high. Okay. Hmm. Intel, like Visa, is a cyclical company. When economic contractions or recessions arise, demand for chips and semiconductor solutions taper. Additionally, it's not uncommon for the pricing power of chip makers to weaken during these downturns, with competitor advanced micro devices recently slashing its sales forecast. It's plainly evident that chip makers like Intel are contending with some tangible headwinds. Hmm. But as noted, time is different of cyclical stock investors. For example, Intel has opportunities that extend well beyond just personal computers, where it's made its home for decades. Businesses shift their data into the cloud at an accelerated pace. Demand for data centers is bound only to rise. Intel can take advantage of this by retaining a significant shares of central processing units used in data center servers. This leads to the next point. Intel's demise has been grossly overstated. Despite AMD chipping away at Intel's CPU share lead in PCs, mobile, and data center servers, Intel still retains the lion's share of the market in all three categories. These are effectively cash cow segments that allow Intel to reinvest in manufacturing infrastructure as well as put money to work in higher growth initiatives. Speaking of high growth initiatives, Intel could benefit greatly from the upcoming spin off and initial public offering of autonomous vehicle company Mobileye. Intel purchased Mobileye in 2017, expects the upcoming IPO to fetch in the neighborhood of $30 billion. This premium valuation comes in the heels of Mobileye hitting quarterly record sales amid 41% revenue growth in the second quarter. Intel. Visa, let's look at Visa. Okay. Two monster stocks you want to buy now and hold forever. So what are they? Amazon, Home Depot. Well into the billions of dollars during that time period. This is as the company grew its position in two major businesses, e-commerce and cloud computing. Today, net sales continue to climb at Amazon thanks to its leadership in these areas, but higher costs and supply chain troubles have been weighing on earnings. As a result, operating income and operating cash flow have been on the decline. The stock price too has suffered. It lost 32% so far this year, and that leaves Amazon trading at less than three times sales. That's close to its lowest level in about 6 years. Here's why this is a bargain for Amazon. Today's troubles are linked to the overall economy. So they are temporary. So so I think I got what this author is trying to say. Uh these days a lot of companies, their price level uh is on downward trend, right? Is on decline. The reason is that it's not because company is making less profit. It's more of a economic issue in general. Um, it's because of interest rate hike and supply chain issues. Uh, uh, like with that applied to uh, economy of a country as a whole. Uh, Even if companies doing well, its price level is relatively lower than last year. Yeah, that's what it is. Let's keep reading it again. So they are temporary. At the same time, the company is making progress in handling them. It's controlling certain costs and improving productivity, for example. Another bright spot is the cloud computing business, Amazon Web Services. It has continued to grow in spite of today's tough economy. AWS posted double-digit gains in sales and operating income in the second quarter. As for e-commerce, the strength of its Prime subscription service should power earnings growth once the economy improves. As it stands today, Prime members continue to spend more and more on the platform. All of this makes me optimistic that Amazon can once again deliver more than just packages. It has what it takes to deliver great gains to shareholders over time. Okay, I agree. Hmm. Palantirs, Zscalers, Spotify. Hmm. Palantir Technology. Okay, Palantir. Let's see. Almost everything you do in life today creates a digital record. And understanding and leveraging this data better than others can drive success in both public and private organization. Palantir makes custom software solutions for its customers using its proprietary platforms. Gotham specializes in government applications and Foundry in commercial projects. For example, Palantir helped determine which areas needed the most assistance during Hurricane Sandy in 2012 using GPS data, photos, damage reports, and consensus demographic records. Palantir's relationship with the government remains strong today. It works with various departments, announcing new contracts from the Army and Department of Homeland Security totaling over $200 million just in the past couple of months. This close relationship also makes Palantir rely on the government, which accounted for 57% of revenue over the next 6 months of 2022. Palantir must grow its private sector businesses, and it's doing that. U.S. commercial revenue grew 120% year over year in the second quarter of this year. The company's long relationship with the U.S. government and strong commercial growth underlines the value Palantir's platform creates. Mhm. The company still has just 304 customers, so there's plenty of room for long term growth. Palantir could eventually be a very large and influential company if data continues to become a critical asset for organizations worldwide. In that case, investors might look back on 2022 finally as an opportunity to buy now, buy low. Hmm. We have Palantir. Now, let's see. Yahoo Finance. Inflation was terrible. Here's why the market rallied. Here's why the market rallied. Sprinkler. Nanostring technologies. Sprinkler. This is like the only one that I'm interested in. After reading this, I'll wrap it up. Okay, it's already past 12 in Korea time. If we're on the subject of beaten down names, then a good place to start would be in the tech sector, the corner of the market that has been particularly hard hit this year. Sprinkler is a SaaS company specializing in customer experience management solutions. The company's AI-powered platform, Unified CXM, helps its client monitor and interact with customers with the aim of delivering better experiences. Some of the world's biggest brands are clients, including Microsoft, Adobe, and Oracle, amongst others. Sprinkler is relatively new to the public markets, having held its IPO in June 2021 in a downsized offering for which the company raised $266 million. The shares were priced at $16 each, but have had a rough time so far. Attractive opportunity for long-term capital appreciation for a number of reasons, including number one, Sprinkler's AI-powered platform that is designed to listen to and manage customer experience data at massive scale across 36 channels and has lots of high value, pursuing a large market opportunity, which is estimated to be $60 billion. We like the leadership of CEO Raggy Thomas and CFO Matt Sarin, who joined in January and is helping focus the company on profitable growth. We think in a tough macro environment, Sprinkler is benefiting from a trend consolidation of solutions. Hmm. Sprinkler. Okay. Okay, this is it for today, and I'm gonna see you tomorrow. Okay, bye bye.